Welcome, I'm Catherine Magana here with Greg Carroll, Rachel Ivanovich, and Vince Stefano, where we're here to provide you some insights about the markets, planning, and taxes. So here we are a week later, and the market really didn't move too much up until today. So here we are, August 29th, and all week long, the markets were anticipating some news from a major AI chip company, and they reported yesterday, and here we are today. The market is up, so we're looking at about 1% gain today, potentially, but anything can happen between now and the end of the day for the Dow, and then for the S&P, it looks like it's about 85 basis points right now. So not a lot of movement, but it was interesting because there was a lot of anticipation this week, and I think as we're phasing into the big Labor Day market, I'm not sure how much more we'll see going on with the markets.
Yeah, it's funny, the market is up on that news from that chip manufacturer, yet that chip manufacturer is actually down. Yep. And it's been leading the market, carrying the market. Yeah. And it's kind of interesting. Maybe we got a little change of leadership happening.
I don't know if that's the case, but I do know that we've said this all along, we're very near the end of second quarter earnings. Almost all of the S&P companies have now reported, and most have done relatively well. You were talking about that company yesterday. Well, actually, three very well-known technology companies reported yesterday. All of them were able to meet or exceed their quarterly consensus, and they guided next quarter, next year, mostly in line. And, the market, again, the market rewards companies that are good companies. So really, the market has responded well, but I firmly believe that this leads back to what we've been saying in these podcasts all along. Number one, dominant, rapidly growing companies with solid fundamentals, with robust product and service offerings, are going to continue to increase their revenue, earnings per share, operating margins, and free cash flow. Now, these companies are where investors want to focus. Now, the market's going to have up and down periods. Stocks will fluctuate. But these superior companies will continue, especially the stocks in the technology space, will continue to offer mission-critical AI, cybersecurity, enterprise software that almost every company in America needs and wants if they want to grow and be successful going forward.
And then I also saw some economic data out there with the GDP coming in a little bit higher than the prior reading. So second quarter, it looks like it's coming in at 3%. So that was higher than the previous quarter, which came in at 2.8. So interesting to see. Obviously, we talked about interest rates, what's going to happen, how that data is going to feed in with the Fed. Should be interesting to see what happens in the next few weeks. But as we've been talking a little bit about interest rates, I wanted to share a little bit about car loan rates. So, obviously we see consumers that like to buy cars, and we don't have that 0% interest and 2% interest that we saw many years ago. But I thought it was interesting that car loans don't track the Fed rates cuts exactly, and that car loans track longer-term yields such as a 5-year and 10-year treasuries. So it's kind of interesting. So if we're expecting to see a big change, I think it will happen, but maybe not as aggressively as some of the Fed rates that we see out there.
Interesting. Yeah, I didn't realize that was not so correlated there, but we're actually currently in one of the longest inversions, meaning short-term rates are higher than longer-term rates, and they usually look at the 2-year Treasury and the 10-year Treasury when they're measuring this. And I saw yesterday, for the first time in over 2 years, it was like there was almost zero spread. They were right neck and neck, but today the 2-year went above the 10-year a little bit, I think. So it's still up there, but traditionally that would not be a good indicator of the economy going forward. But this economy coming out of the COVID recession, markets, I should say, that have really threw everything kind of into a different type of cycle that we've never seen before. So, the consumer's been more resilient. The market's been more resilient. It will be interesting to see how 2025
Well, the government threw enough money at everybody right after
There was a lot
COVID,
of
and
money.
the problem is a lot of that COVID money is now starting to dry up, and that's why you're starting to see a lot of the consumers become stretched not only on mortgages but on credit card debt and other types of payments that they have to make on a monthly basis. And unfortunately, that could be a factor going forward. I don't know how much, because people have been talking about it for the last 6 to 9 months, and the market has done extremely well. So, when that raises its ugly head, I don't know, but you do have a point there.
Yeah, at some point.
So as we're looking at, we do retirement planning and financial plans for clients. So I'm always kind of looking for articles, information. And one of the things I came across was 6 rules for traveling in retirement. So I thought I'd share that with you today. So one is travel off season. I think if you're not in retirement, you probably want to travel, anybody wants to travel off season.
I'm going to Alaska in December.
Are you?
It's going to be
But
dark
those are
the
good
whole
deals,
time.
and there's less people.
You're going to Alaska in December?
I think, sure, why not? Apparently, it's a great
might
time
be
to find
better than
moose.
January.
You might want to go to Puerto Vallarta instead.
You in Puerto Vallarta, Vince loves it there.
Okay, I'm sorry
That's
to interrupt.
Okay, a second one is choose secondary destinations. So obviously there's the big, places to go, but why not check out?
Why not go to Anchorage?
Yeah, and maybe Vince has a couple this year.
I think that's
You
a
traveled
secondary.
little. And then don't be shy with strangers. So often part of traveling is meeting new people and sharing experiences. And sometimes strangers may know things that you don't know. So that was kind of interesting. Focus on just a few things. So sometimes I think when we travel, we think I have to go do everything. But the reality is maybe break it down into a few trips and really focus in on certain areas or things to do. And then stay at least 3 nights in each location. So I think if you're traveling, packing up and unpacking and moving around a bunch, I'm not sure that's
really
the
good
most
advice.
relaxing thing to do. And then be prepared to improvise. So obviously you have a plan in place, but be prepared to try new things out. And so once again, if you do a lot of traveling in retirement, those are some kind of tips.
Be
But if
ready
you're-
to spend the night in the airport.
Well, there you go.
Seriously, pack a toothbrush, change of clothes. It's happened to me the last, 5 trips. We've had layovers. We've had even something to keep you comfortable when you're in the airport.
And then we had a client that was traveling abroad, and they lost his luggage, so he had to go scramble before they went on a cruise.
Absolutely. Bring a toothbrush in your purse
There you
or
go.
your bag.
Yeah, you get all these cyber attacks and
Oh God, I'd hate to be at the airport for their.
So that's a great idea. Make sure you're prepared at the airport.
So I've been dealing with Roth IRAs and clients this last week quite a bit. And for those of you who don't know, Roth IRAs are great ways for savers and investors to grow their wealth. But unfortunately, not everyone can contribute to a Roth IRA if your income is too high. For instance, you are ineligible to make that contribution. The advantages of a Roth IRA is that it's the tax-free growth, and then the money, when it's withdrawn after age 59 and a half, it's tax-free money on all of it. So we put the money in post-tax and then comes out tax-free.
But it needs to be in there.
For
5
5 years.
5 years.
5 years.
There's
yeah.
always
So that-
some nuances, right?
What's the
that-
income requirement?
The income requirement, so if you're single, if you make more than about $150,000, and if you're married, it's about $230,000 if you're married filing jointly. So higher income earners, let's just say.
But if you have a Roth 401k, there's no income limits.
Correct. So we're going to I wanted to talk a little bit, touch on that, because a lot of people have been asking about, well, can I do a backdoor Roth? What is a backdoor Roth? And then what's a mega backdoor Roth? So they are different. And so basically with a backdoor Roth IRA, what you do is you contribute to, so there's there are lots of types of IRAs, but let's just, for simplicity, let's talk about the traditional IRA where you put the money in pre-tax, grows tax deferred, comes out, all of it's taxable. Then you've got your Roth, you put it in post-tax, grows tax deferred, comes out tax-free. Those are the two. Let's just stick with those. If your income's too high, you still can contribute to a traditional IRA, but you don't get the tax deduction if your income's over a certain dollar amount. So you can make a contribution to a traditional IRA, don't get the tax deduction, and then you just turn around and you convert it to a Roth right away. And the income limits don't apply at this point. So in essence, if you do it at the same time, put the money in and then do the conversion, which I still don't understand how this is a loophole, but it is. you don't pay tax on it because there is no growth. If you put the money into a traditional IRA as a non-deductible contribution, you let it grow, you would pay tax on any of the earnings, but not on the principal that you originally contributed. There's some tricky rules called the pro rata rules, so you do need to be careful with a backdoor Roth because you have to look at all of your IRA accounts, so simple IRAs count, SEP IRAs, traditional, and you have to look at the balances in all of those. So let's just say you worked for an employer previously and you had a 401k and you left that employer and you rolled that 401k into a traditional IRA or IRA rollover. That money then counts, and you haven't paid tax on it yet. So if you try to do the backdoor Roth, the conversion there, you'll end up paying tax on a pro rata basis. So there's a portion of it that will be taxable, a portion of it that is non-taxable. So definitely work with an advisor when you're considering this because you can get yourself into trouble when you're doing that.
Yeah, that would be a bad tax surprise.
It's a bad surprise.
And I think people don't realize that pro rata rule. And so every time the idea is like, oh, I want to go do that. But then once we talk to our clients and we kind of figure out, okay, this scenario and run it, when you look at that pro rata, it may not be as advantageous.
Yeah. So the pros really of doing a backdoor Roth is you're getting around those income limits. So the backdoor allows you to contribute to the Roth IRA even if your income's too high. The tax benefits, of course, is a pro. Money in that Roth can be withdrawn tax-free in retirement as long as you've had the account open for 5 years. And then with Roth accounts, which are different than the traditional, you don't have to take any required minimum distributions after a certain age, unless it's an inherited Roth, which that's a whole other story. Right?
Go into the weeds there, but
that's another podcast. Yeah. So if you have that Roth account, you can continue to let that money grow tax-free until you need it. So you don't have to take out any RMDs for Roth IRAs. So those are the pros. And the cons to that backdoor Roth is there could be state or federal or taxes that apply to it. That 5-year rule applies. You have to make sure that you've actually met that. So make sure that the money's already been in there for that long. So I mentioned the other sort of backdoor Roth, and they're calling that the mega backdoor. And you kind of touched on that, and that has to do with 401k accounts. And so 401k accounts are employer plans that you would have, and typically you put money into a 401k through a salary deferral, and the amount that you put into or contribute to your 401k is not taxed in the current year. It's subject to Social Security and Medicare taxes, but it's not subject to federal or state income taxes for the most part. So you have to think about buckets of money. So with your salary and with these 401k plans, oftentimes there can be the traditional 401k, which is a salary deferral. You get the tax write-off when you put the money in. So that's bucket number one. That's pre-tax contributions. The second bucket is some 401k plans allow for Roth 401ks. So you have to make sure and check with your employer that this option is even available. So that's Roth. That's the Roth bucket. So the money goes in and you don't get the tax write-off for it when you put the money in, but the money grows tax deferred, comes out tax-free later.
And that's part of the salary deferral.
That's part of the salary
so you can
deferral.
Either do Roth or pre-tax.
Correct.
If the plan allows it.
If the plan allows it, correct. So most plans allow for the pre-tax contributions. Some plans now are allowing for the Roth contribution. Then there's actually a third bucket that a lot of people don't even know exists, and that's after-tax contributions. So you got your three buckets. You got your pre-tax, your Roth, and then your after-tax bucket. And I would say probably it's not the norm that there is the after-tax contributions. So if you even want to attempt the mega backdoor Roth, you do have to confirm that your employer's plan allows for after-tax contributions. So like it sounds, this is money that goes in post-tax, grows tax deferred. Your original contribution is not taxable because you already paid tax on it. The earnings are taxable when they come out. So it's kind of a hybrid of the pre-tax and the Roth. So with a mega backdoor, what you do is you have to fully fund your salary deferral first. So that's the $23,000 plus catch-ups if you're over 50. And then if your employer's plan allows for it, you can fund up to $69,000 total. So another $46,000, let's say, you can put another $46,000 into this after-tax bucket. And as long as there's no other money sitting in that bucket that it's earnings, you can convert it over to a Roth IRA.
So you're rolling it out of the plan right away.
Yeah,
pretty much.
Exactly.
And if you don't roll it out of the plan and there's earnings, then it's a little more tricky.
Exactly. So it's a great way to be able to put more money away in a tax advantageous way. But keep in mind, not everyone is eligible for this conversion strategy. There are those two steps. You make that after-tax contribution, and this is different than a pre-tax or a Roth 401k contribution, and then you convert it. So you just need to make sure that, depending on the specifics of your employer plan, you may or may not be able to be eligible for this.
So you need to work with a qualified financial planner or tax person to kind of find your way through all those weeds to figure out if it makes sense or not.
Yes.
The tax.
I was reading
tax forest.
a newsletter from Ed Slott, who I've heard he's like the tax guru for IRAs ever since I've been in the business for the last 30 years. But he's still going strong. But he was put out this little newsletter the other day, and he was talking about the new, you mentioned, Rachel, the new inherited rules. And he says with the new inherited IRAs, other than a spouse, it's turned into probably one of the worst assets for wealth transfer or estate planning ever. And so what he's suggesting is, we are in the President Trump put in the 2017 Tax Cuts and Jobs Act, which lowered all the tax brackets 1% to 4%. And those are set to expire at the end of 2025. So in November, depending who is in office come January, you can kind of tell whether those are going to be extended or not. And if they're not extended, he's suggesting, you have 2024 to convert very large IRAs into a Roth this year and in 25 before those tax cuts might go away. But because when people inherit them, and a lot of your largest clients have IRAs, in retirement you think that your income is going to be a little bit lower, but your best clients with these super large IRAs are probably still going to be in the highest tax brackets. So maybe paying taxes at the lower rates now.
I mean, 37 versus 39.5 or 39.6 or whatever it's going up to.
Yeah. And then you can have it growing in that tax deferred, eventually coming out tax free as long as it's been in there 5 years or longer. So, just another thing to maybe talk to your financial professional about is like, should I be taking these distributions out now, starting to convert it? Maybe you're in your 60s, early to late 60s, especially, if you're coming up to 73 and you have to start taking large RMDs out, maybe, you want to get ahead of the curve a little bit.
Yeah. So there's, so what you're speaking of is Roth conversions, and there's partial Roth conversions in certain amounts, and that's what we're here for, is we can run those numbers, and because you also have to factor in, are you taking Social Security? What about Medicare? And and there's some other variables, and what kind of income do you have coming in? But potentially, yes, there might be some brackets or ways you can start moving some, but you have to look at everything to make sure it makes sense. So absolutely something we're here to help if you want to look at that. And once again, it's kind of case by case, even though we read everything, it says everyone should do this, but the reality is it really depends on each individual situation. So I know we covered a lot today. Thank you all for joining us, and we hope you have a nice Labor Day weekend, and thanks for listening.
Adios.
Thanks.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.